thought last week was busy, you'd better put your tin hat on, because in the coming week we will have even more macroeconomic and company news heading our way. Top down, the big news will come in the form of two items. First, the latest monthly UK manufacturing, construction and sentiment surveys, or Purchasing Managers Indices, PMIs. We don't get them from just here either, but from America, China and Europe as well throughout the week. Remember, a score above 50 is generally seen as indicative of growth, one below 50 as indicative of a slowdown or even a downturn. For March in the UK, manufacturing was strong at 55.1, but services weakened and construction went below 50. The second item to watch is the latest interest rate decision from the US Federal Reserve on Wednesday the 2nd of May. The consensus seems to be that there will be no change in policy, but groundwork will be laid for a second quarter point or 0.25% hike of the year in June, with a continuation of quantitative tightening, QT, as the US Central Bank shrinks its balance sheet by 30 billion a month this quarter, 40 billion a month from July, 50 billion a month from September. This chart shows why that might matter. After all, quantitative easing, QE, may have helped markets as the Fed bought bonds to depress bond yields and force cash into stocks to create a wealth effect. We now have to find out whether QT may have the opposite effect. Bottom up, almost a fifth of the FTSE 100's members are due to release results or trading updates or host their annual general meeting for shareholders this week. Key names to watch include a trading statement from wobbling media giant WPP on Monday the 30th of April, when its new co-chief operating officers, Mark Reed and Andrew Scott, will give the first commentary on trading at the company in 32 years without Sir Martin Sorrell at the helm. Full-year results from Grocers Sainsbury, trading statements from Standard Chartered Bank and bookie Paddy Power Betfair on Wednesday the 2nd of May, trading statements from mining giant Glencore and healthcare equipment specialist Smith & Nephew on the 3rd of May, and finally first quarter results from megabank HSBC and British Airways owner International Consolidated Airlines on Friday the 4th of May. But for all of that, I suspect the biggest source of potential fuss will be oil major BP when it publishes its first quarter results on Tuesday the 1st of May. As we can see here, BP shares have rallied nicely of late, boosted by an oil price which has made a beeline for the $75 a barrel mark, buoyed by ongoing OPEC supply discipline, fears over President Trump scrapping the Iran sanctions deal struck by his predecessor, potentially excluding Tehran's supply from the world market, American sanctions on Russian oligarchs and companies, even though no individual oil firms have been targeted, and also wider unrest in the Middle East. We can see how movements in the price of oil, and gas for that matter, affect BP's quarterly profits in this next graphic, although the company's cost-cutting and efficiency programs can help it to maximise returns and minimise any downdraft if and when prices fall. This chart looks at replacement cost before tax, which excludes the change in value of inventory to try and smooth out some of the effect of movements in oil and gas prices. As you can see, the number still moved around an awful lot owing to asset write-downs or gains on disposal. In the first quarter of 2017, BP made a replacement cost profit of $1.5 billion, as upstream, exploration, made a profit of $1.2 billion, and downstream, refining and petrol stations, made a profit of $1.7 billion, and then other expenses, including tax, came to $1.4 billion to take the number back down. This chart shows the quarterly performance of upstream and downstream back to 2013. A higher oil price should help upstream, although it does increase downstream's input costs. And although analyst research does suggest that refining margins should hold up pretty well, as capacity utilisation across the industry remains pretty tight. Other features to note include ongoing costs related to the 2010 Gulf of Mexico oil rig disaster. Do keep an eye on this number, not least because BP attempted to draw a line on the whole sorry affair with a $5.1 billion charge in Q2 2016. That took the total cost to over $60 billion, but even that wasn't enough. BP took a further $1.7 billion after-tax charge for claims associated with the spill in the fourth quarter of 2017. Another item to watch is the tax charge, in light of the cuts in US corporation tax pushed through by President Trump late last year. BP took a $900 million hit on its tax assets in Q4 2017, but should benefit going forward from the cut in the headline US company tax rate from 35% to 21%. The combination of a lower tax charge and higher oil price could help profits and boost cash flow, and that's important because it's cash flow that funds the dividend. And in the fourth quarter, BP didn't actually generate enough cash to cover the dividend, so it has used a combination of disposals, investment cuts and debt to cover the shortfall. Remember, BP's dividend comes around $1.6 billion a quarter and capital investment $4 billion plus. Profits aren't quite enough right now. The next chart shows cash flow from operations minus capex minus tax and compares it to the dividend. The cash flow is the line, the dividend is the bar. None of this suggests, of course, that BP is going to cut its 10 cents per quarter dividend, especially as oil prices are on the rise. And also remember that BP felt sufficiently confident to launch a share buyback in Q4 to offset any dilution caused by the issuance of shares as scrip instead of a cash dividend. For additional reassurance, do also watch comments on the capital expenditure budget, about $16.6 billion last year, and also net debt, which finished 2017 at $37.6 billion US. Thank you for watching, and I look forward to seeing you next time.